Hello and welcome to Livewire Markets. I'm Ali Selby and today we're very lucky to be sitting down with Michael Ackland, the Chief Financial Officer at Telstra. Since reporting its result in August, Telstra's share price has slid around 9%, with investors feeling disappointed by the company's shock decision to maintain ownership of its InfraCo fixed infrastructure business. Today we're going to learn why the company made that decision, and we'll also be touching on the company's latest results as well as Telstra's growth plans for the future. Thank you so much for joining me today, Michael. I'm really excited for this discussion.
Great to be here.
Contrary to what investors may think from that share price slide, Telstra reported a really strong result in August. Earnings per share increased 16% over the year. What other numbers do investors need to be aware of?
Yeah, thanks, Ellie. It was a great set of results that we announced in August, and so a couple of numbers I'd point people to. So one is we saw our income grow by around 5%. We saw our underlying EBITDA, so earnings before interest, tax, depreciation and amortisation. It's before a lot of things, but our underlying EBITDA grew almost 10%, which included our acquisition of Digicel Pacific, which is a telco across the Pacific that we acquired earlier in the financial year. So without that, we grew around 5%. We also increased our dividend, and the board, given the underlying earnings growth, approved an 8.5-cent final dividend, which took our total dividends to 17 cents fully franked, which is up about 3%.
Okay. Free cash flow fell around 78% over the period. Where have you spent the majority of that cash?
Yeah, it's a great question. So free cash flow was down. A big driver of that was a change in working capital, or a normalisation of working capital, particularly driven by us selling more phones in the period. So that phone sales were down during the COVID period, and because we sell phones on a plan and people pay it off over time, you end up with working capital. The other place that we spent the money is our CapEx did increase from 22 to 23, and that was really driven by two things. One is our investment in Digicel Pacific, so we're upgrading and increasing our investment in that asset that we've taken on. And the second one, which is a really exciting one, which goes to your previous part of the sort of context in your intro, is we're increasing our investment in infrastructure, particularly our investment in inner city fibre. So these are the big fibre cables that connect all the different capital cities around the country, and demand for that is really exploding. So that was $1.4 to $1.6 billion of investment in digital infrastructure over the next couple of years. So that's been the big shift on cash flow.
You mentioned earlier that you increased your dividend to 17 cents per share fully franked for the year. How are you planning to continue to increase that dividend in the future?
Yeah, so we're really committed. We have a capital management structure and framework that we commit to our shareholders, and it's got two really important parts. One is that we are going to maintain an A-rated balance sheet, and our balance sheet is in a great position, and that's driven by our ability to manage debt and our ability to generate cash flow. And the second is to maximise the payment of fully franked dividends and seek to grow it. And so seeking to grow those fully franked dividends is driven by our ability to grow earnings. And so there's really a couple of things I'd point to in our results that drove that growth in earnings and will continue to drive growth in the future. One is our mobile business, which grew almost 9% on earnings, and has been a big driver of our growth, and we expect that growth to continue as people continue to rely and use their mobiles more. The second area of growth was international with the Digicel Pacific acquisition, but also our infrastructure businesses across Asia Pacific and Europe and the US are also growing. And lastly, the last part of the growth was our infrastructure business. And so when we look at growth into the future, we really do see in the medium term our mobile business and our infrastructure business driving that growth.
Let's stick with infrastructure and obviously the InfraCo stake that investors were quite upset about or disappointed by when that wasn't announced that you were going to be selling a stake in that business. Why is maintaining the status quo the right decision for Telstra?
Yeah, it's a great question, and there was very mixed and different views across our investor community, and many of the investors were very supportive of the decision to keep InfraCo in-house. So there's really two major reasons that we want to keep that in-house, and we think that is best for shareholders, particularly in an inflationary environment. One is the demand for digital infrastructure, we think, and our opinion of this has hardened, I guess, as over the last 18 months, is exploding, driven by initially sort of that move to the cloud, driving demand. But we're at the start of a wave around generative AI, which is going to generate huge demands for digital infrastructure. So that will be in data centres, but it'll also be in moving the data between those data centres and between people's applications. So we think there's a huge growth opportunity in digital infrastructure, and we think about our InfraCo business as a digital infrastructure business. And we're investing, as I said, in intercity fibre as one of those growth investments. The second part is we think there's further opportunities for efficiency across that infrastructure business. And that can be in terms of power usage and optimising power usage, but also optimising the use of that infrastructure that's spread all over the country right now. So we thought it was the right thing, both in terms of accelerating the improved efficiency from infrastructure, but also we think that we are a good investor in that growth in digital infrastructure, playing into that demand that we're seeing starting to explode with the start of that wave with generative AI generating so much demand.
You talked to it being the right decision also in this kind of inflationary environment. How has Telstra been impacted by higher rates and also higher levels of inflation?
Yeah, so as I said, from a higher rate point of view, that it's really made the importance of having that A-rated balance sheet. That has put us in a good position, but our borrowing costs have still gone up. We're also, if you think about the things that we spend a lot of our money on, a lot of our shareholders' money on, it's on building infrastructure. So think about construction of infrastructure. So that means fuel costs, labour costs. We're feeling that inflation. We're a big power user. So all of that data generates power, all of those sites and little data centres we have all around the country, exchanges, and our mobile phone towers use power, so we've seen power cost inflation. And lastly, we also have a big digital capability, so data and AI resources, software engineering resources, so we're seeing that inflationary impact. So we are seeing inflationary impact into our business. We are still very committed, and we've made a lot of long-term investments that are paying off on keeping that cost discipline and keeping that in focus. And we did commit to taking $500 million worth of cost out from 22 to 25, and we expect to deliver the vast majority of that by 25.
How are you passing those costs on to your customers, and what's been the reaction so far?
Yeah, so we made a decision a couple of years ago, in our mobile business particularly, that we wanted to be really transparent around the way we were thinking about pricing, particularly for mobiles. So mobile, it's a big capital intensive business. There's huge demand. In fact, just in the last 12 months, customers' demand for data went up 30% on the mobile network. And we need to make sure we're making an adequate return so we can continue to invest in all the infrastructure that people want us to put, whether that's expanding coverage or increasing capacity on the mobile network to cope with that demand. So we made the decision that we were going to put a CPI link into our contracts and that we would review pricing every 12 months. We did that. We've done that for a couple of years, and we did that last year as well, and we did increase prices. Clearly that's always a tough decision, and we remake that decision every year. We did decide to do it this time because we thought it was important to make sure we were getting those returns so we can make those investments. We have seen reaction from customers, of course. People aren't happy about it. It's been well within what we expected in terms of churn. We also are now in a position where we don't have contracts. Our contracts are month to month on our mobile plan, so people can change plans, leave us, buy prepaid, use one of the other brands in our stable of brands where they may get a different price or downgrade their plans. So tough decision. Reaction has been broadly within what we expected, and we think it is the right thing, along with that cost discipline, to make sure that we're in a position to invest in the kind of services that people are demanding.
Okay, I want to talk about Digicel Pacific.
Yes.
What growth are you seeing there since the acquisition?
Yeah, so growth has been in line with our business plans for Digicel Pacific. It's performing really well. It's a very different market, obviously, to Australia, particularly PNG. So this is a market where mobile phone penetration is really low, and it's about more people using mobile phones and getting access to mobile phones, and so that we call it, subscriber growth is what's driving that growth. And then we've also got other markets within the Digicel platform across Fiji and other markets that are a little bit different. But no, we're really pleased with how Digicel Pacific is performing. It's a very different kind of market to Australia, which is very well penetrated. We're also investing in upgrading networks across PNG to give people even better access.
There's also been quite a lot of coverage on the bid that you made for Australian company Versent.
Yes.
Why explore an opportunity like that?
Yeah, so we announced recently that we're doing a transaction with Versent. So if I sort of step back, one of the things that we see as core to Telstra's brand is helping Australians and Australian companies get the most out of their technology. We've done that by we've had a long-term position of investing for network leadership and connectivity leadership. You know, we bring the best of 5G and we brought the best of 4G and we bring the best of 3G to the Australian community, and we will continue to do that. What we're doing with Versent and what we've done with our Telstra Purple business, which is our tech services business, is we have technology consulting capabilities. We have around 2,000 staff right now in our technology consulting, managed service, professional service business, helping companies do that. And we're a big reseller of all of the hyperscaler cloud services capabilities. Versent brings more of that. That brings us another over 500 consultants into that space that can help our customers and their customers get onto the cloud, transform their business, drive digital transformations across different parts of the Australian economy. So it's very synergistic with what we have, and it plays exactly into where we think there is growth and where we think we can continue to play a role, which has been Australia's gateway and Australian companies' gateways to technology and getting the most out of it.
You've obviously want to grow, and even just then you talked about wanting to grow in the future, being more than just a telco. How do you avoid diworsifying in the future?
How do we avoid?
Diworsifying. It's like diversifying, but for the worst.
I like that. Yeah, it's good. So we're very, it's very important we remain, and we are very disciplined on where we make investments, both in terms of returns, but also where we have a right to play. And we have a right to play around core connectivity. We will continue to invest to be a leader in that space. And that means we're going to grow our infrastructure business, our InfraCo business. We're going to grow our digital infrastructure and invest against that demand, which is significant. And we think we can capture significant value there. We're going to continue to make sure we lead in mobiles and provide that differentiated network experience. I mean, Australia has one of the best mobile networks in the world. That's no accident. That's around long-term investment by players like us, but also other players in the market. And then in this third space, the tech services space, we think that does fit very closely with our core and where we really bring some advantage. So yes, we want to diversify our earnings. You'll see in our earnings, it's been, the last little while has been very mobile focused, and a lot of our growth has been mobile focused. But we're not looking to I can't even say
Diworsify.
it. Diworsify. It's a great word. We think that we've got the right guardrails in place around both those financial guardrails around where we'd invest, but also we're very, very committed to the value that we bring, which is, we really see our role, and we think our role has been for a long time, helping Australia get the most out of the digital economy and giving Australia access to great technology infrastructure and digital infrastructure to support the economy.
Okay, you're currently working on your T25 strategy. How does that set Telstra up for the next 10 years?
Yeah, so the T25 strategy was really important, and there's probably a couple of things that I would point to that really set us and are really sort of putting the foundations in for our growth going forward. So one was around network leadership, and that's been absolutely a pillar of our T25 strategy, that we will continue to invest to be a leader in connectivity networks and the delivery of those, and we think that plays long term. The second was the setup of the infrastructure business, so we made the commitment to separate out and give transparency to that infrastructure business, and we think that has positioned us incredibly well for the growth that is coming. And the third pillar I'd point to that we haven't talked about as much is that we made some very big commitments that we were going to set our company up to be a digital leader, so a leader in digital operations. So that means that we've invested hard in data and AI. We've got a partnership with Quantium, which gives us access to some of the country's best data scientists, and is putting us in a position to be a partner for companies and individuals around how they get the most out of AI. but also the way we've thought about our own software engineering, our own technology setup. So we've put a lot of effort in there so that we can move faster. But really importantly, why being a digital leader and setting ourselves up that way for growth is we know to stay ahead of the technology curve, we have to be a much better partner and we have to be a much better collaborator with all of the people who have developed that technology. So they're the really big three foundations for me.
Okay, I'm not a Telstra shareholder, but there are obviously a lot of retail shareholders who own Telstra. Why should they keep holding for the next 5 years, and why should I be buying right now?
So I think there's really two reasons. We are well advantaged in an area where there is obvious demand, and that demand is growing. And so if you're in a business where you're providing a product that people really want, and we can see that on the digital infrastructure side, and you've probably spoken, data centers, providers, and all of the people who are playing into that demand from hyperscalers around cloud, around generative AI. So we've got that huge demand on the infrastructure side, and we're going to invest in that, and we've committed to that. And the second one is if I just look at connectivity, and particularly mobile, we're playing into a product here where demand for that product, so data usage went up 30% just last year, and I don't see that slowing down. I don't see the demand for those connectivity services slowing down. So the reason I would hold Telstra is that we're well advantaged, we're well set up, we're safe and secure, but we are in a place where demand continues to explode, and with generative AI on that demand for that infrastructure, we may well be at the start of another wave of growth.
Okay, I just want to end today with a question from one of our readers. His name is Bernard. He asked, why didn't Telstra pursue a Starlink-type satellite strategy over the past decade?
Yeah, so we absolutely believe satellite is a great complementary technology to all of the connectivity technologies we're doing. We didn't want to own the satellites, but we are partnering with OneWeb. We're partnering with Starlink. In fact, we're launching a world first. I think it's a world first. It's definitely an Australian first with Starlink to provide voice and broadband services through low Earth orbit satellites for Australians. Satellites are a global business to a significant degree, and we want to partner with all of the different satellite providers to provide access to our customers to the best experiences.
Why didn't you want to own satellites?
Well, we made that decision not to own satellites. I think if you look over the past decades, satellite investments have gone through some significant cycles, and they probably haven't been a great investment. We think the right opportunity for us is to partner with those satellite providers, and we're going to partner with them in two ways. So one is by reselling those services as part of an integrated connectivity service from Telstra for businesses and consumers, and the other is we are building the ground and terrestrial infrastructure for those satellites, because when it goes up to the satellite, it's got to eventually come down and get into the internet somewhere. And so part of our investment is with partners like Viasat, where we're building the ground infrastructure for them. So we think we play a role across that satellite ecosystem.
Okay, well, thank you so much for your time
Pleasure.
today,
Thank
Michael.
you.
I absolutely adored this chat. Thank you so much.
No, thanks, Ellie.
If you enjoyed that too, don't forget to subscribe to Livewire's YouTube channel. We're adding so much great content just like this every single week.